Good morning, everyone. Thank you for joining us today for our Banking and Finance Academy. It's our last one of 2022, and it's on borrower distress. Are you prepared? My name's Lindsay Lee. I'm a senior associate at Brody's, and I'm joined today by my colleagues Louise Laing and Jamie Nelany, also senior associates in our restructuring and insolvency team. So today's topic, as we've seen, is on the very topical subject of borrower distress. Just in terms of setting the scene before I hand over to Jamie and Louise, UK is predicted to be in recession, and there's a lot of factors at play. There's global factors such as increased energy prices, increased food prices due to the war in Ukraine and COVID, low labour challenges, and Brexit feeds into that. Drop in consumer spending and cost of living pressures on household budgets, to name just a few. The Treasury's also talked about tough times ahead for the UK economy and strong global headwinds. So against that background, Jamie and Louise are going to look at the impact of all these factors on business borrowers, and they're going to talk us through recent market trends. We'll look at media messaging, what the statistics are telling us, and what we are seeing in practice, financial distress, the various signs that a borrower is in distress and what action can be taken at that stage, the solvent solutions and options, so what solutions are available to solvent borrowers in financial distress in order to avoid tipping into insolvency, and lastly, restructuring and insolvency processes, and Jamie and Louise will walk us through the various different processes available. At the end, if we have time, which we hopefully have, we'll take any questions you might have for us. And if you have a question that you'd like to submit, please do that through the Q&A function and we'll pick them up at the end. If you could leave your name alongside a question, that will enable us to pick up with you afterwards if we don't have a chance to get to your question in the live session today, and we will do that. And on that note, I will hand over to Jamie.
Thank you, Lindsay. There's been a recurring theme in the press and the insolvency market generally at different stages since the start of the first COVID lockdown, that a wave or a tsunami of insolvencies is on the horizon. It wasn't difficult to find a few headlines for this slide, but in reality, there hasn't been a wave, or at least not yet. At the start of lockdown, the first lockdown, I would guess that most of you would have predicted an increase in insolvency numbers, and we were the same. We all thought the wave was coming. But what in fact happened was that corporate and personal insolvency numbers started to drop. This was due to a number of factors, but primarily the government measures of imposed moratoriums on enforcement action and the various government guaranteed loan schemes. These measures were aimed at stopping the wave, and they worked well, or perhaps even too successful, because rather than just stopping a wave, they actually resulted in numbers dropping significantly below the pre-pandemic levels. And this means that post-pandemic, there's an element of catch-up where businesses that perhaps would have failed in the ordinary course were kept afloat. Throughout the pandemic, there were spikes of activity in certain sectors. There was a sharp drop in casual dining outlets as restaurants were forced to close, significant staffing issues, and people's habits changed. Some well-known names like Pizza Express, Byron Burger, and Carluccio's all went through a restructuring or an insolvency process. The issues that the retail sector was facing pre-pandemic, including changes in consumer behaviour, unaffordable rent liabilities, and a switch to online shopping, were accelerated by the pandemic with several high-profile failures such as Debenhams and Arcadia. The start of the energy crisis led to several energy suppliers failing around the end of 21, start of 22, including People's Energy in Scotland, and the largest, which is in the press at the moment, being Bulb Energy, which was ultimately bailed out by the UK government. Generally though, and particularly with SME businesses that dominate the UK and particularly Scotland, restructuring and insolvency activity has remained low over the past 3 years. And we would say, in fact, the lowest since at least the pre-financial crash in 2008. Another recent trend that we're starting to see is an increased focus on directors' behaviour, including HMRC being given new powers to investigate directors of dissolved companies. This follows the much reported bounce back loan fraud, where the scheme, which had minimal checks on borrowers, has been exploited. Claims against directors is an area we expect to get busier over the next couple of years. So with the pressures that the economy is now facing, is the wave now coming? If we can move on to the next slide, Jack. So the government support measures were largely faded out during the first half of this year, and we're starting to see the headlines talking of big increases in insolvency numbers. But if you look at the statistics for Scotland, which do reflect a similar picture happening across England and Wales as well, we can see that whilst the overall numbers have been increasing, they are skewed by a large extent in terms of due to increases in the CVL process, with other insolvency processes remaining relatively static. Louise will cover CVLs in more detail later on, but as a brief word on it, it's a process initiated by the company itself. And so not generally a company being forced into an insolvency process by a creditor. And these tend to be smaller companies that have perhaps taken on too much debt to get through the pandemic and have no way of trading out of their situation. And also zombie companies that are likely that would have failed regardless of the pandemic. And so the catch-up element that I mentioned earlier. We are starting to see insolvency practitioners reporting increased activity in terms of advisory work. And there is a slight increase in administration numbers, which suggests that businesses, certainly larger, more trading businesses, are starting to face pressure. Lindsay gave a summary of the factors weighing down on businesses. I mean, they really are stark: inflation, the cost of borrowing, soaring energy prices, the availability of labour, supply cost, mini budget. It goes on. It's a long list. It's hard to predict the shape of any downturn. But given the volatility in the market, we think we can expect increased restructuring and insolvency activity in 2023. Over to you, Louise.
Thanks, Jamie. I'm now going to take a look at financial distress. So generally, people do not like to admit they're in financial difficulty and will often try to hide it. So what are some of the signs to look for? As a lender, the first sign is often a breach of the loan documentation. However, borrowers will usually try to keep their lenders happy and avoid a breach and the risk of enforcement action by continuing to make loan repayments and cut back elsewhere. Therefore, it is important that lenders have appropriate financial covenants in place, which are tested regularly, so that any change in a borrower's financial performance is flagged as early as possible. Some of the other things to look out for are delayed or non-payment of liabilities. Extending creditor days by delaying the payment of invoices can be a sign of financial distress, as can non-payment of tax liabilities and the retention of pension deductions. Cutbacks within the business. Failing to maintain property and equipment or invest in new technology will often be due to a lack of available funds, as is the cancellation of staff bonuses or benefits, and a reduction in the level of remuneration which the directors draw from the business. These are just some of the actions which a borrower may take as it tries to manage its cash flow during a period of financial difficulty. Other signs of financial distress can include increased stock levels, which can indicate a slowdown in orders and could have a negative impact on the balance sheet if the stock is perishable or likely to become obsolete. Finally, increased management stress. Where a business is in financial difficulty, management will feel under immense pressure. They will be concerned about the future of the business, potential impact on their employees and suppliers, and their own or their family's financial position, all of which is likely to have a negative impact on their behaviour and general well-being. So when financial distress is identified, what's next? What is appropriate or possible will very much depend on the facts and circumstances of each case and how much time is available before the business runs out of cash or someone takes action against it. This slide applies across the board to the business in financial distress, to its suppliers and other contract counterparties, and to lenders to the business. From a lender perspective, a lender will want to understand the nature and extent of the problem and what action and advice management are taking. The lender should also take its own advice. Internally, the account should be passed to and/or considered by the high risk or other relevant department. And externally, advice should be sought from accountants who can carry out an independent business review and lawyers who can carry out a security review, and both of whom can advise on options. The lender should then consider its options. If the problem is capable of being resolved, is there anything the lender can do to assist while still protecting its own position? Or if the business cannot be saved, what action should be taken and by whom? Jamie will now look at some of the solvent options or solutions available before we conclude with a brief overview of restructuring and insolvency processes.
Thanks, Louise. In most cases, stakeholders will want to avoid insolvency, and that's certainly usually the case for lenders. And so what options are available for businesses in distress to try and avoid insolvency? The first on the slide is debt refinancing or consolidation. Refinancing can cover a wide range of steps, from amending the current loan terms to refinancing with a different lender. It could involve debt write-off, but usually it's a reframing of the terms of repayment. It can be a useful tool for dealing with where there are short-term cash flow difficulties, particularly where there's an income shock and then there's an expectation that cash flow will improve. Where there are longer-term issues, though, with the financial viability of the business, it may just be a sticking plaster and not really appropriate. Factoring and invoice discounting, these both involve a lender giving a business a cash advance against an invoice, with the lender then receiving payment once the invoice is paid to the customer. A business's current lender might provide these products, or they might be directed to specialist invoice discounting lenders that can sit alongside the current lending package. The main benefits are to provide more certainty and predictability on cash flow, but again, they will not address issues of underlying financial viability. Director loans, it's always worth exploring whether directors or the shareholders will provide a cash injection. Any loans will typically be subordinated to any other creditors, and there are restrictions in the insolvency legislation preventing companies from repaying directors' loans in priority to other lenders. Other creditors, sorry. So, a useful option if available. Equity investors, this is primarily aimed at private equity type investment, and there's still plenty of liquidity in the market, so it's available for the right kind of business. Now, that's typically perhaps a business that's at the early stages of developing an idea, and which can then forecast success in the future. So a private equity fund may be willing to invest cash with a view to getting a share of that upside in the future. So a good option for the right type of business. Asset business sales, does the business have assets or perhaps parts of the business which are non-core or loss-making, which could be sold? Or even in more desperate scenarios, it could be good parts of the business which would realise sufficient funds to allow the remaining business to be, to continue. This would typically be following a review or an options analysis that might be carried out by a restructuring accountant. HMRC time to pay. The revenue are often one of the biggest creditors alongside banks, and they're also often the instigator of formal insolvency. And so it's important for businesses in distress to keep dialogue open with the revenue. A time to pay arrangement allowing a business to spread out its tax liabilities over a longer period will usually be agreed, provided the business has been otherwise compliant in the past. It's important for businesses to stay on top of the revenue, because if time to pay arrangements are not stuck to, then they can quickly find themselves facing winding up petitions. And then informal and credit arrangements, this can be anything in terms of amending terms to repay debts. I think one arrangement that we'll start to see more of is arrangements with energy suppliers, given the huge increase in energy costs. I think we'll see energy debt as a significant creditor in a lot of businesses struggling. So I expect to see more and more kind of informal arrangements with these types of suppliers. Back to you, Louise.
Thanks, Jamie. Well, thanks to new legislation introduced during the pandemic, there are now 6 main processes in the Restructuring Insolvency Toolkit: administration, liquidation, receivership, CVA, restructuring plan, and the moratorium. We're now going to take a brief look at each of these. First of all, administration. Now, administration was first introduced by the Insolvency Act 86 and was substantially reformed by the Enterprise Act 2002, which introduced Schedule B1. The Enterprise Act also introduced restrictions to the ability to appoint receivers where the whole or substantially the whole of the company's property is attached by the relevant floating charge. The changes came into force on the 15th of September 2003, and since then the number of receiverships has declined and the number of administrators has increased. And administration is now the principal enforcement route for secured lenders. There are 2 appointment routes. A court application may be made by the company, its directors, one or more creditors, or a combination of the foregoing, or, and more commonly, the out-of-court route may be used by the company, its directors, or the holder of a qualifying floating charge. That route involves the giving of certain notices and filing copies at court. Now, administration, regardless of who makes the appointment, is a collective process. Administrators are appointed to manage the company's affairs, business and property for the benefit of the creditors as a whole. The purpose of administration is set out in statute, with the primary objective being the rescue of the company as a going concern. And that is generally quite difficult to achieve, as the corporate entity will be burdened by the debts and other liabilities. In the last 19 years, I've been involved in 3 administrations where the company itself has been rescued, all with completely different circumstances and using different mechanics to achieve that result. It is more common for administration to achieve the second or third objectives of achieving a better result for creditors as a whole than would be likely if the company was wound up, or realising property to make a distribution to secured or preferential creditors. Now, we can't talk about administrations without mentioning pre-packs. A pre-pack is essentially where a sale of the business or the assets is negotiated and agreed in advance of the administrator's appointment and is completed immediately after the appointment is made. Pre-packs get a bad press, but they have their place in the insolvency toolkit. We've been involved in a number of pre-packs over the years, which have allowed trading to continue uninterrupted, and they've protected value, preserved jobs, and minimised costs. Moving on to receivership. As I've mentioned, restrictions on the appointment of receivers to the whole or substantially the whole of the company's property were introduced back in 2003. However, the appointment of receivers is still possible if the relevant floating charge predates that date or is restricted to specific assets of the company, or one of the exceptions to the restrictions apply. It should be noted that we don't have fixed charge or LP receivers in Scotland. In Scotland, there are 2 routes to appoint receivers: a court appointment on the application of the holder of the floating charge, or by the floating charge holder itself by way of instrument of appointment. Receivers are appointed over the assets charged by the relevant floating charge, and their primary duty is to the holder of that charge. They will typically realise the assets over which they've been appointed and distribute money received to the holder of the relevant floating charge before handing over any surplus to a liquidator to deal with the claims of ordinary creditors. As the statistics showed earlier, there have been no receiverships in Scotland over the last 2 years. However, where customers have remained loyal to their lender and a Pre-Enterprise Act floating charge is in place, receivership will be another option to consider in an enforcement scenario. Moving on to liquidation. Get the next slide, please. Thanks. I mentioned earlier that there are 6 main processes, but with liquidation, we get 3 for the price of 1. We have compulsory liquidation, creditors voluntary liquidation, and members voluntary liquidation. As members voluntary liquidation is a solvent process, we're not going to cover that today, but we'll take a look at the other 2. Firstly, compulsory or court liquidation. This is where a petition is presented to the relevant court and a winding up order is made. The petition can be presented by the company, its directors, any creditors or any members, or by all or any of them together or separately. Typically, the ground for seeking a winding up order is that the company is unable to pay its debts. Now, some of the terminology can get confusing, and as you'll see on the slide, there are provisional, interim and permanent liquidators. Before a winding up order is made, it is possible to seek the appointment of a provisional liquidator, whose job is primarily to safeguard the company's assets, pending the court's determination of the application. When a winding up order is granted, the court must appoint an interim liquidator. The interim liquidator must, within 28 days, seek nominations from the company's creditors and its members for the purpose of choosing a permanent liquidator. Now, the role of the liquidator is to gather in the company's assets, realise them, and make a distribution to creditors. On conclusion of liquidation, the company is dissolved and struck off the register. It should be noted that there is no official receiver in Scotland, so there is no liquidator of last resort, and an insolvency petitioner must be nominated and consent to take the appointment when a petition is presented. The creditor's voluntary liquidation. Now, despite the name, and as Jamie has already mentioned, a CVL commences upon the passing of a resolution by the company's shareholders that it should be wound up voluntarily. However, in practice, the process begins with a meeting of the board of directors and a decision by them that the company is insolvent. The directors will then resolve to convene a meeting or send a written resolution to the company's members so that they can consider a special resolution that the company be wound up. If there's a holder of a qualifying floating charge in relation to the company must give written notice of the proposed resolution, and either give them 5 business days notice which must expire, or the qualifying floating charge holder can give their consent before they can proceed to pass the resolution. The resolution of shareholders will normally nominate a liquidator. Once the resolution has been passed, the company's directors are required to issue a notice to creditors seeking their decision on the nomination of a liquidator within 14 days of the resolution being passed. Then the creditors can either approve the shareholder's appointment by nominating the same liquidator or nominate an alternate liquidator to replace the shareholder's nominee. Once appointed, the liquidator's role is the same. They gather in the company's assets, realise them, and make a distribution to creditors. Again, on conclusion of the liquidation, the company is dissolved and struck off the register. I'll now hand back to Jamie to cover the remaining processes.
Thanks, Louise. So the first one I'm covering is our CVAs. So a creditor's voluntary arrangement is a proposal by a company in distress to its creditors involving a compromise of debts. Once the company makes the proposal, the creditors then vote on it, and it's approved if 75% in value of the creditors who respond vote in favour. All of this is done without needing to involve a court. So they're more like a contract between the business and its creditors than an insolvency process. They are supervised by an insolvency practitioner, but the company remains under the control of the directors. And where we see these CVAs used most commonly is to restructure businesses with large rent liabilities, such as retailers or restaurant groups with multiple rented properties. CVAs of these type are structured so that creditors are put into different classes depending on how their debts will be treated. And so typically, for example, suppliers to restaurants will be paid in full, whereas landlords, especially those for the less desirable sites, will face potentially a significant write-off. They have been criticised by landlords in the past, where votes are perceived to be flooded by those creditors receiving the most favourable treatment, leaving some landlords forced to go along with less than favourable new terms. Despite this, landlords have not had a lot of success in terms of challenging CVAs in the courts, and so we expect they will continue to be used to restructure over-rented businesses. A CVA does not affect the rights of secured creditors or preferential creditors unless they agree to the proposals, and so typically they will not compromise secured lenders. The next process covering are restructuring plans. So restructuring plans is a new process introduced by the Corporate Insolvency and Governance Act in 2020, which was put in place in early 2020, just after the first lockdown. They are a development of the restructuring tool called schemes of arrangement, and they involve a company, again, making a proposal to its creditors, and so there are similarities with CVAs. Also, like CVAs, creditors are typically split into different classes depending on the treatment of their debts. It is a court process, though. It involves 2 court hearings, an initial convening hearing, and then once the creditors have voted on the plan, there is then a sanctions hearing where the court will approve or reject the plan. The key feature that distinguishes restructuring plans is the ability for cross-class cram-down. And what that means is that a plan can be approved even where one or more classes of creditors have voted against it. Plans can compromise secured debts where CVAs can't. And so it's possible, for example, for secured creditors to be forced into accepting a write-off under a restructuring plan. And this makes them a very powerful and debtor-friendly restructuring tool. But to date, restructuring plans have been used to restructure larger businesses with complex financial structures. The need for at least 2 court hearings tends to mean that the costs involved are large, and generally they have been seen as prohibitive for smaller businesses. And then moving on to moratorium. This is another new tool introduced by SIGA in early 2020. It's known as the Part A1 moratorium, and not to be confused with the moratorium that is given under other processes like administration. It's a standalone tool. It's designed to give companies in financial distress a short breathing space and a payment holiday to enable them to complete a turnaround. They last for an initial 20 business days with an ability to extend that for a further 20 business days. The key to being able to use a moratorium is the need to be able to demonstrate that something positive is likely to happen for the company during the period. So, for example, the company might be likely to complete a refinance in the 20 business days. Certain debts, though, must continue to be paid during a moratorium, including payments due under facilities to lenders. So that does limit their application. They are overseen by an insolvency practitioner who would be appointed as a monitor. and a monitor must certify that in their view it is likely that a moratorium will result in the company being rescued as a going concern. And so they need to be confident that the positive change, such as a refinance, is likely to happen. Now, this is quite a difficult hurdle and putting quite a lot of onus on the insolvency practitioner. And as a result, the take-up has been quite low, very low in fact. I mean, we think there's possibly only been one used in Scotland and a handful in England. So it remains to be seen whether the rules will be relaxed or court rulings will change how these operate to make them more user-friendly. And until that happens, we don't expect to see this tool widely used. That concludes our quick canter through the insolvency processes. And I think back to Lindsay.
Thanks, Jamie. I'm keeping an eye on the clock, but I think we've got time to squeeze a couple of questions in. Louise, if I could start with you. Now, you sit on the R3 Scottish Technical Committee, so you might have a perspective and a view on this. Jamie's talked us through restructuring plans, which are obviously quite a new addition to the restructuring toolkit, and we've obviously seen them being used in large and quite high profile, in relation to quite high profile companies such as Virgin Atlantic, Pizza Express and Premier Oil. Do you think we're likely to see it used by smaller companies, for possibly in the SME space?
I think the hope is that it will filter down and be used more widely and by SMEs. Obviously, as Jamie's touched on, the costs at the moment are perhaps prohibitive, and it has been used in more complex cases. That there was, I think it was earlier this year, the case of House, which was claimed to be the first use of the restructuring plan in the SME kind of sphere, but from recollection, I think the figures were still quite chunky there. But I think R3 do hope to run some training on restructuring plans, just to show that how they can be applied effectively in the SME marketplace, and maybe provide some templates as there as well, which should hopefully make them a bit more accessible and reduce some of the costs if people have something to work with there.
Thank you. And Jamie, probably a bit of a big question. You said in your talk that we've not yet seen the big increase in insolvencies which are being trailed in the media, and you also said that it's hard to predict the shape of a downturn, but it'd be good just to get your views on what we might be likely to see. What's the trend going to look like? What are your thoughts?
Yeah, thanks, Lindsay. I suppose that's the question that we and the market generally has been trying to answer for the last couple of years and trying to predict. And a lot of us have given up predicting when it's going to happen or what it's going to look like, because it hasn't really followed what we'd expect. I think generally businesses have shown a lot of resilience through the pandemic period, perhaps more than we would have expected. But I think now we're starting to see business sentiment surveys reporting increasing concerns. Late payments for businesses are increasing, so there's definitely an increase in pressure, which is starting to show. There's a drop in consumer confidence, spending habits are changing. We've got the typical, a lot of businesses will wait for the festive period to see how trading is, and then they have a cyclical dip in the start of next year. So I think we will always see that. I think it will be felt particularly strong this year. So I think that will lead to some distress. I think if we draw comparisons to 2008 financial crisis, things are different. In 2008, a lot of the debt sat with the traditional banks, and I think that has changed. There's a lot more lending from alternative lenders, and so there's a far more disparate community of creditors. So we don't necessarily know how they will all treat distress. So that's a change. And I think there's a lot more liquidity in the market now. So there is still a lot of liquidity. So I think to summarize, what we'll see is we will see an increase in activity. I don't think we'll see a wave or a sudden falling off the cliff or increase. There will be more insolvency, but there's more money in the market, so there'll be more options. So you might see a lot more solvent solutions, I think, before seeing insolvency. Sorry, that's a long-winded. It's hard to predict, and yeah, more activity, more liquidity, and kind of watch this space.
Lots of thoughts there. Thank you, Jamie. But all that remains is for me to say thank you for joining us. Have a wonderful festive season, and please do join us at our banking academies in the new year. Thank you.
Thank you.